Ackman and JCPenney are breaking up, and we've got a special guest to help us look at the housing numbers. You're in the right place, folks, because this is where the money is. Hey everybody, I'm Allison Southwick, and today I am joined by David Hanson, banking and finance analyst here at the Motley Fool, and we've got a special guest, Blake Boss. He is a consumer and industrials analyst here at the Motley Fool, and so he's going to help us bring a different perspective a little bit to the show today.
Thank you, Allison.
Oh, we're all very excited. Hopefully it's a good perspective. I just said different.
I'll do my best.
Not going to overpromise here. All right, as always, let's start with the headlines. First up, Reuters is reporting that JCPenney Ackman set terms for future share sales. Basically, activist investor Bill Ackman owns about 18% of JCPenney, and he's looking to get rid of it. And he stands to lose about $300 million on the deal here.
Ouch.
So, right? So
Yeah.
Breakups are so sad.
They are sad.
They're so sad. You have to pick a side and decide who you're still going to hang out with. But what are you thinking about this breakup?
Well, this is a pretty nasty one. Bill Ackman's kind of that guy that came in and dated a woman, and maybe she had a self-esteem problem going into the relationship. They broke up. You know, his reputation gets hurt a little bit, but she's the one that's going to be hurting for a long time and who's really going to suffer. So I'm going to have to side with JCPenney on this one. It's kind of unfortunate what's happened to the company over the years, and with Ackman and Ron Johnson and how that didn't go according to plan. But, you know, hopefully things turn around for the company. It's not looking so good right now, but we'll see how it plays out.
Do you think they're going to be better without him? They might miss him, but
I think so, because
eventually...
it'll get rid of a lot of the drama, and I think the company will be able to really focus on getting those customers back that they lost. But that's not easy, and it's not looking good so far. And you look at their interest expense and how much money they would have to increase. They'd have to increase their revenues by over 100% on operating income just to cover interest expense at this point, and that's not going to be easy to do.
Oh, yeah. David, do you have any thoughts on this?
I mean, the JCPenney stock obviously been taking a beating. The Bill Ackman stock, if there was such a thing, I don't know what the ticker would be, maybe ACK or something.
Just ACK.
That's at an all-time low, I think, right now. So I'd potentially be buying Bill Ackman stock right now. I think the bears are in full force against Ackman, so just kind of a fun story to watch. I'm not interested in the JCPenney stock. It could certainly be a turnaround story. That's why he bought it in the first place, as a turnaround story. So it could happen in the long run. It's not a business that I'm super excited about, so I'm staying away from that stock. Maybe buying the Bill Ackman fake stock.
All right,
If I
moving
might
on.
add, too,
Yeah.
the JCPenney stock trades at 0.24 times sales, which seems low, but if you look at a company like Radio Shack at 0.07 times sales, they're both priced to be nothing or maybe a lot smaller, but you're still paying a lot more for a JCPenney type of turnaround story, so keep that in mind if you're looking at JCPenney as an investment.
JCPenney or Radio Shack. Do you want to give me some other options to invest in here?
Those aren't two very fun options.
We've gone back to 1995 on
Yeah.
this.
Right. I'll stock up on mom jeans and radio-controlled cars. All right, next up, Wall Street Journal is reporting we've got a ton of new housing numbers out today. New home construction is up 5.9% in July. Mostly the construction was for apartments, while single-family home construction fell. Apparently, some economists are believing that rising mortgage rates are scaring people away. So, David, do you think that's really the case here?
I think it's potentially the case here. It's down month over month or whatever, but year over year it's still up double digits, so it's not like construction's still in the depths of where it was the last couple of years. When we look at this from the bank's perspective, something that Matt and I do on the show a lot of the times, it kind of confirms what we thought we were going to see with Wells Fargo, JP Morgan, even Bank of America to some extent. Those are the biggest mortgage originators in the country here. With those higher rates, the trade-off of when to buy a house, when not to buy a house, just doesn't make sense all the time when rates go up, and you're seeing that tick through in the construction numbers. So that's kind of where I'm sitting with it. It's not much of a surprise to me.
Now, Blake, when you look at this, do you see any investing opportunities?
Well, you know, the housing rebound investing thesis has been around for quite a while now. You know, after the housing bubble burst, everybody's like, okay, now it's time to invest in housing. You know, I'll get a rebound play. And so we've seen that since 2009 now. So unfortunately, you know, you might be a little late to the parade on this one. So a lot of the housing companies you can look at, like Weyerhaeuser, Boise Cascade, and these are lumber companies primarily. You know, they're pretty expensive. You know, you're paying a lot to invest in these companies. They're highly capital intensive. If you think like a business owner, I would not want to go out myself and buy a whole business where I didn't make very much cash. And that's the way to look at your investments when you're thinking about a housing rebound. How much cash is that returning to you when you look at it from the cash flow statement? And that's what I'd caution investors. But a lot of these plays are very overvalued, all the way from the home building companies like KB Home, all the way down to the product suppliers like Weyerhaeuser and Boise Cascade.
And
Yeah.
when you look at the housing space too, you got to define what your time horizon is too, because over the short term, like Blake said, some of these stocks may be overpriced to some extent, but we still are going to have a shortage in housing, in physical housing, over the next 10, 15 years as more families come into the market. Because of the recession, there was no building for so long, and we're still don't have a lot of inventory sitting out there for those future families that will be started. So over the long run, there still will be construction. Over the short term, there's going to be these ups and downs, some months up, some months down. But over the long term, this is still an industry that's going to be around, and there's going to be winners in the space.
And moving on from headlines, it's time to take a deeper dive. Yesterday, we had the first ever Motley Fool Financials fantasy draft.
Yep.
It's very exciting. I wasn't here, but we were joined by Billy Kipperstock and also Brendan Matthews, who helped out. You weren't here either, so this will be a fun preview for. Right. So we actually have the results. If you could put that up on the screen here, Alfred. So here's the picks that everyone made. You guys had 6 rounds and a few rules that I'm not going to bother going into. But David, when you look up at that board and see what everyone picked, are there any that you're just kicking yourself over that you didn't get?
I mean, I obviously like my team. I think it's the best one out there. You got JP Morgan, world-class bank, world-class investment bank, consumer bank, asset management. Love my first pick there. Also love the Markel pick. That's a kind of a get-rich-slowly stock, in my opinion, one that's going to be a 5, 10-year, 15-year holding. But when I do look at the other teams, there are some picks that I was a little envious of. Matt over there got Capital One and Discover Financial Services. These are smaller players in the banking space. A lot of people think of Capital One as just a credit card company. It's much more than that. I think it's the 12th biggest bank in the country. I like their future prospects diversifying away from just credit cards. And also Discover. For so long, Discover was seen as catering to just the low-end consumer there. They're making progress internationally, continuing to gain market share here in the U.S. So those are the 2 picks that I was kind of envious Matt of. Also on Brendan's side, Progressive Insurance. We know the commercials. Flo, I think her name is. Some people might be annoyed by her, but it's actually a pretty good business model. Direct insurance sales. They don't go through sales agents, so they can provide cheaper pricing, and they're innovative with stuff like the Snapshot, where it's something that you actually plug into your car, and it tracks your driving preferences, so they can more accurately price your model,
Which
give
I
you
have
better
used,
prices.
by the way.
Oh, you have?
There we go.
Oh, okay.
I did not qualify for a discount.
That's a shame.
Bummer.
So those were 3 that I was jealous of, I guess, or I thought they were great picks. So that's where I stand. I still like my team, though.
All right, great. Now, Blake, you weren't here, but after taking a look at what everyone got, whose roster do you think is the strongest? And you don't have, David obviously thinks his is the strongest, but is that true?
Obviously, David's a little biased, but
A little bit.
I'm going to go with Team Billy. I like the Wells Fargo. I like Berkshire. I like MasterCard. Not a lot of people across the world actually use debit or credit for their transactions. A lot of that's in cash or check. And then Wells Fargo and Berkshire are obviously some really strong companies for long term. And then he threw in a little eBay, which is not a financials pick per se, but they do have PayPal, which is very financially, and get a little diversification with that eBay.
Yeah, he did get that Berkby. I think that was the top pick, right? Top overall pick?
It was, yeah. He had the number 1 pick.
Big shocker.
And we're tracking all of these in a Motley Fool Caps account, too. I think we have a picture of that, too. There you go. There's the name. TMF Stock Draft 13, so you can hold us all accountable. You can celebrate me when my picks do great, or see what happens to Team Billy as Blake's predicting big things for them. So that's the Caps account. You can follow us there, and we'll be updating that and having commentary on that going forward throughout the fantasy football season.
All right, you guys. Do you guys have anything on the line here?
Not yet.
Not yet.
Just pride right
All
now.
right, pick something good. That'll make it fun. All right, moving on. It's time to look at some high flyers. There's a few stocks out there right now that have seen amazing runs lately. Specifically, we're looking at Tesla. They're up 321% year to date. Zillow up 220% year to date. B of I up 100, or Bank of the Internet. Sorry, I'll say for those of you who don't adore Bank of the Internet, up 139%. So, David, what are you thinking about Zillow right now? 220%. Is that overvalued, or what do you think?
I'm a Zillow shareholder. It's been a nice run. I think the valuation is a little too optimistic right now. I'm not running out there and, I guess, averaging up. Not many people average up all the time, but I'm not doing that right now. I don't see this. I see it as a long-term winner, but right now the optimism around the stock is almost at an all-time high. It did fall back after the reported earnings. I still don't think the fundamentals are quite there to justify this valuation. BofI, on the other hand, Matt and I have talked about in the past that this is very richly valued now. You mentioned up over 100% this year, now trading at around 3.5 times book, which sounds crazy when you compare it to a bank like Wells Fargo and JP Morgan, which are trading around 1.5, a little bit less, 1.5 times book. So almost 2 times more, or 3 times more than those bigger competitors there. However, the business is performing very well, growing deposit base, growing loans. And when you look back to Wells Fargo in 2003, something I'm sure everyone does. In 2003, Wells Fargo was trading at around 3.5 times book. So it's not crazy to see banks trading at these multiples. We're not used to it because the last couple of years have been so anti-bank. Valuations have been pushed down so far. But there was a time when banks did trade at this multiple. So I can kind of see how BofI makes sense. It's still very expensive, but the fundamentals are somewhat there.
All right, the other one to cover here is Tesla. Like I said, up 321% year to date. Is Tesla flying a little too close to the sun? I almost want to make some sort of rocket reference, but I know the rockets are another Elon Musk thing.
Yeah,
So
well, Tesla is a really interesting company because I think a lot of it comes down to their their compensation package, especially around Elon Musk. And they actually have a market cap goal, by 2022. I believe it's around $43 billion, which is a lot higher than the market cap today. But I think a lot of investors look at that, and Wall Street for that matter, and they're like, oh, well, it should be a $43 billion company then. But that's not entirely how the world works. That's a long way out in the future, and you should be compensated for the risk you're taking when you're investing in a company over time, and you should get paid for that risk. So right now, you're not getting paid a lot for the risk you're taking. And I do think Tesla has done some phenomenal things. It's a great company to follow, but since it's rallied so much, it's a huge company, and they haven't really warranted that valuation yet, in my opinion, that I think shareholders would be better suited to kind of sit and wait here and see if the company, achieves some of its goals coming up with that Model X sedan. If they get that prototype done, it goes well. How the Model S continues to sell next year as they satisfy the backlog, and kind of really wait this one out and check and see. It is a really cool company. I'm not real bullish on it because I just can't get behind EVs for some reason. That's largely a personal opinion of mine, and anybody's welcome to adjust that, analyze that debate how they want, but I just can't get behind Tesla at today's prices.
How much would it have to fall for you to be slightly interested in saying, maybe I'll pick up a few shares?
Well, since I'm more of a hybrid guy, not a pure EV guy, I'd have to say at least 50%. I mean, It'd have to fall quite a bit for me. But if you believe wholeheartedly in electric vehicles only, then and you can rationalize that debate, logically for yourself, then maybe you'd be willing to pay more than I would. That's just my personality.
Gotcha.
all right. Well, we brought you on to get your personal opinion. So that's it. So at this point, usually we head to the Twitters, but exciting news. We have our first mailbag time. We got our first question. It was submitted on Facebook. And it comes to us from Mary Jane Hillpot. She asks, what percentage of my portfolio should I devote to taking a chance on individual stocks? And she lets us know that the majority of her portfolio is in mutual funds. So, David, do you have any specific advice for her?
I'll let Blake go first on this one.
Really?
Well, I've answered this question a few times, and actually, we're not allowed to give personalized investment advice, but this is a really good question. And what I usually advise people, if you do have a lot of money in like your 401k, maybe your employer's managing it, a good thing to do is find a company you really enjoy that, you love following, maybe you really like its products, invest in that company in a small way. And what it does is it just kind of helps you follow the market and makes you more aware of your retirement, makes you pay attention. And plus, it's a lot of fun to follow companies. I love it. That's what I do every day. So obviously I'm a little biased, but it is a really fun thing to do. And when you're thinking about investing in one stock, I always like to think about it in the case of, okay, my portfolio is this big, what percentage of that am I willing to lose? All of it. So if I wanted a $10,000 portfolio and I was only comfortable with losing 5%, then I would say, okay, I'm only willing to invest in $500 in a particular company, because then, if it goes to zero, I only lost 5% of my portfolio.
Yeah, I think that's a good way to think about it. And she mentions the mutual funds. I think one thing to do first is be aware of what are these mutual funds that you're in. Blake mentioned employee-sponsored 401ks. So many times people are out there and just saying, well, I have my 401k. I don't really know what I put it in, but there's some mutual funds out there and they've done well so far. I would really go in and look at each of those funds that you are invested in, because you are invested in those funds, even if it seems indirect through your employer. It's your money that's going into those. So I would go in, look at those funds, make sure the expenses are reasonable with what the performance has been, because there's index funds out there that their expenses are almost zero, very, very minimal, but there are mutual funds out there with expenses over 1% each year of what you have in that fund, which can be very taxing over the long haul. So I would caution to say, look at those funds, know what you're invested in, and if you are interested in investing in individual stocks, look at what your mutual funds have invested in as well. Because what you don't want to happen is your mutual funds be heavily invested in a company like Apple, as many mutual funds were, and then you go put a ton of your personal portfolio in Apple. So I would just caution to make sure you know what's in those mutual funds. If you're interested in buying individual stocks, make sure it lines up and that you're properly diversified if something were to happen, like Blake said, something go to zero. So that's kind of the approach I would take it. There's certainly not a set percentage. Everyone should have this invested in individual stocks, this in bonds, this in mutual funds. It's very much a personal preference, and see what you're comfortable with and go from there.
So that's where a financial advisor is a person to go to, a registered one, that is. So you can always go to your local Wells Fargo branch, for example, and visit a financial advisor. And usually they'll do a free consultation with you to look at your retirement portfolio.
All right, and there's tons of advice to heed on the Motley Fool website about both looking at mutual funds, buying your first stock, and finding a reputable financial advisor, because
be tricky.
It's extremely tricky.
Yeah.
And so we don't want to make it sound like it's that easy, because it's something to really take your time and look into. Really quickly, for Mary, is there any book that you would recommend she read before she takes her first jump?
Ooh, well, my book is, well, the title, I'll say it. It's called F Wall Street by Joe Ponzio. It's one of my favorite Wall Street books of all time. Obviously, the title is a little vulgar, but it is very good, and it makes you think like a business owner. And it's very good. It's a good entry-level book, and I think most people could understand it without a financial background.
All right, David, do you have a book?
I'll go a little bit boring. Blake mentioned investing in something that you're going to care about, follow, something that you kind of understand. I'll go with the boring Peter Lynch, One Up on Wall Street.
Wall Street.
Not a boring read,
It's a good-
read, but it's a
good
traditional one. Not very surprising, but for beginning investors, I think that really is a good thing, just to get your head around business concepts and get something that you're interested in.
All right, well, I think that covers it for today. On behalf of David Hansen and Blake Boss, I'm Allison Southwick, and we will see you on Monday.